that eventually there comes a time when people want to take their profits and leave. Now, the experience of the late 1990s, the internet bull market boom, was that they all were going to the door at the same time. And the door was only so big. So that many people were pushing through, and not everyone got through. That was then. Could it be happening right now? Let's get the read from Charlie Gasparino, Daniel DiMartino Booth here as well, Michelle Schneider as well. Michelle, following these type of markets as you have, I'm just curious whether we do have something to worry about. Normally when you hear big hedge funds and the rest could be in some trouble because of this, I automatically think, uh-oh, is this like a big bank in trouble deal? What do you think?
Well, I think the only time that I can say that really reckons to this one is not just the dot-com bubble that you mentioned, but also what happened in the commodities exchange back at its heyday. From 1979 to 1982, you had silver, which seems like a joke now, go from 5 to 50, but at the time that was a huge move relative to just the percentage of performance. And eventually, the Hunt brothers tried to corner the market there too, and it took years for the COMEX governance boards and for the CFTC to try to figure out how to control it, and they eventually did. So we could be looking at a situation like that now. Of course, everything on terms of time frame is so much faster than it used to be then. But at this point, I think they're... Yeah, right. And so they're scrambling to try to figure out. The SEC can look at short selling, but there's really no rules being broken at this point other than the fact that the kids are enraged because they feel like for years the market was manipulated and now it's their turn.
Yeah, and they're trying it. Charlie Gasparino, the issue here is that it's a sign of frothiness. And a lot of people have been talking to me today. Well, that's a certain sign of the cap. Now, you can look at that from a variety of ways. If those betting on stocks collapsing are wrong and they're paying for it, that's one thing. There's generally this feeling that it has that late 90s feel to it because these are just rapid moves, multi-billion-dollar exchanges of shares that change the entire equation. What do you think?
Right, and the stocks that are trading, I mean, GameStop is not worth $300 a share. I mean, I think that's a reasonable thing. BlackBerry, when was the last time you used your BlackBerry? Is that worth the run-up it had? And by the way, this is all these, as we've been reporting first on Fox Business, we're way ahead of the curve. All these stocks have been, this is known as a bull raid. It's been going on for weeks now. People are just now freaking out, but we've been talking about this for a while. Couple points to make. There's a more contemporary example of issues involving stuff like this other than the Hunt brothers, and that's long-term capital management when that hedge fund blew up. Right. Now, what was problematic about that, what made it systemic, was that all of Wall Street and other hedge funds copied LTCM's trades, right? They're trades that were going bad, so there was a systemic risk that the financial system could collapse. I'm not saying it's going to happen here, but there is this issue, and that's why the markets are off of a systemic risk that other hedge funds could collapse and they need bailouts or whatever. I mean, that's why the markets are off. There's that fear.
Yeah, we don't want to get ahead of ourselves. That is a risk, but it was raised by Elizabeth Warren, who wants to look into this. She's concerned about it. And then,
they're going to look into it.
When I hear that sort of thing, I mean, I begin to wonder then, where does this go? Because the fear is that the little guy, the little investor, is going to get stuck holding these gains, hang on to them, try to sell normally and not be able to. And then it's kablooey. And then you have that concern coupled with these big institutions that are apparently losing a lot of dough, and a lot of them tied to these very hedge funds that are taking it on the chin. Are you worried?
Neil, if you're asking me the question, I will say that there is definitely cause for concern. The very first question that Federal Reserve Chairman Jay Powell was asked at the press conference at 2:30 Eastern was, what was his view on GameStop and what was happening? A subsequent reporter asked him the question, are you considering raising margin requirements? Neil, right now we have margin debt at a record high, higher than it was when Alan Greenspan said irrational exuberance and stocks ended up bubbling into 2000. And we also have hedge funds with net leverage that is also at a record. So to Charlie's point, the potential for systemic risk, the potential for there to be interconnectivity between one investor to another, that spillover risk is definitely apparent in the markets today.
We should just explain margin debt, of course, refers to those who use the leverage the money they've made on their stocks to buy still more stock. When it's going your way, you're in clover. When it's not, you're screwed. Yeah. But Charlie, are you worried about that?
Yeah, well, isn't it ironic that Powell's opining on this when he's one of the reasons why this is going on? I mean, listen, you can blame a Robinhood, low cost trading or zero commission trading. You can blame people being locked in their apartments because of the lockdowns and they have nothing to do but speculate in markets. But the reason why there's so much froth in the market, why it's so easy, why leverage is so high, why margin debt is up there so much, is because we have 0% interest rates. When you have 0% interest rates, people do risky things to make a buck because they have to go out on the risk spectrum.
Are you saying, Charlie, we're going to see more of this, or this more risky stuff, more risky behavior?
If by the way, the only way you change this is to change the risk dynamic, and the only way you do that is to raise interest rates, which he said he's not doing.
All right. So, Michelle Snyder, let me ask you this. A lot of people are hearing this and saying, I want in because I'm looking at what's happening to AMC, and it's tripling and quadrupling, and BlackBerry, which I thought was dead and gone, is doubling and tripling. I want in. I want in. What do you tell them?
Well, first of all, the fact is that it is transparent what they're looking at. If you look at the Reddit site, it's right there. So the fact that people want in, I think, is part of what the free market is all about. And so I would say to have some set of rules. We look at using certain types of ranges, like we like to see where the market opens, give it about 5 minutes, let the dust settle, and if it breaks out from there, we might get in at that point. It doesn't matter exactly what rule you decide to use, but you should have some kind of risk adjustment and some kind of place to take profits along the way, and then decide, are you doing it as a day trade to join the fund, get out and go home, or do you want to keep it overnight, or do you just want to keep rotating into the next thing and the next thing as these names keep popping up?
All right. Very good. Guys, thank you very, very much. There is such a thing as taking your profits or getting greedy and waiting to get still more. It's a delicate balancing act, and history shows that oftentimes investors poorly execute that. So we'll be following this. We're also getting